Hello, Internet. Welcome to Capital Letters, Episode 3. Is this deal real, or is it just a total waste of your time? That's the question that every single lender should be asking themselves before they even open the model. So, welcome back to Capital Letters. I'm glad you're here. I hope you're glad to be here. We like to break down how investment banking works to lenders, sort of how the middle market deals actually get done. Not a lot of fluff, maybe some bad jokes, a little bit of clarity. I'm Jesse. I'm with MidCap Global. We're an investment bank that likes to live in the messy middle there. We just like to help real companies get real capital and help lenders get to a yes faster. So today's episode, a little more tactical. We're getting into the fun stuff. So you're going to figure out how to filter deals fast, like 5 minutes fast. Ask any woman I've ever known. That's much slower than me. But let's be honest, there's a lot of noise out there, right? Teasers that go nowhere, founders that have no clue. You got models that are held together with flex tape. You do not have time to waste on garbage. You need to figure out how you very quickly filter these so you can spend your time on important things. You know, a way to look at a deal and say, this is worth my time, or this is bullshit. That's what we're going to be building today. Hell yeah, let's go. What is the very first signal that tells you a deal might be legit? Great question. You ever get a deal and just know, like, within the first minute that it's getting absolutely nothing across to you and it's going nowhere? So that instinct, that's earned. And it's usually right? So lenders, well, humans just in general, but lenders especially, you live and die by patterns, right? Pattern recognition. You don't underwrite cash flow. Well, you do underwrite cash flow, but you underwrite other things. You're underwriting professionalism. You're underwriting presentation. You're underwriting precision. And that gut check in the first 60 seconds is one of your most powerful filters. But let's make it conscious, right? Let's unpack exactly what it is that you're sensing and figure out a way to turn it into a process. So the 3 C's are what I like to call them. 1, clarity. Can you describe this business in 1 sentence? A bad example would be, we're a dynamic, vertically integrated platform sending supplies for water-driven. No. We distribute plumbing supplies to contractors across the Midwest. I know what that business does. Number 2, coherence. Do the numbers support the story? If they're claiming 40% EBITDA margin on a construction services business, I would be wary. And if there's no definition for EBITDA, if it's ever confusing, or any footnotes at all that point to some of the things that they're talking about, that's suspicious as well. Number 3, context. Does the teaser fit your space at all? Debt providers, they want cash flow clarity. They do not want SaaS style growth multiples or equity upside. That's for venture. That's for PE. So some red flags to spot really fast. Vague use of proceeds, right? General corporate purposes, dodge that one. Urgency without structure. 101s in 3 days, but no data room. Or formatting issues. A lot of typos, inconsistent fonts, things just overall sloppy. Maybe that one's a pass. Green flags, however, is there a specific ask? We are looking for $18 million in senior secured debt for CapEx and working capital. Define timeline and process. Data room live. CIM is ready. Is there a professional tone but not hype? The bottom line, your first 60 seconds are going to tell you how much time of the next 60 minutes that you're going to give to it. So trust that. Does the capital ask match the business, or does it make you say, wait, what the hell? So take a second and ask yourself in the moment of truth, when they send the ask, does it make sense? Is there structure clarity? Are they seeking senior debt, mezzanine, equity, or flexible growth capital? Flexible growth capital is actually a synonym for indecision. Size logic. $2 million EBITDA business, asking for $20 million in debt, that's 10x leverage. That's not likely. And then use of proceeds. Are you buying equipment? Are you doing an acquisition? Are you refinancing? Are you buying out a partner? You see, saying growth isn't enough. There are 1,000 different types of growth and 1,000 different ways to do it. What does that mean? Show the breakdown, show the timeline, and instrument fit, right? Working capital needs? Well, that's a revolver. Acquisition? Well, that's a term loan. Cash burn? Great. That's equity. Mismatch signals chaos. And what did I say on one of these previous episodes? Lenders don't like chaos. So what I ask them, why this amount? Show me your math. Does it make sense? Why this structure? What other options have you looked at? Can they answer that question? And what if things take longer or cost more? Do they have any margin for error there? So a good example, we had a business that asked for $15 million to expand, but half of the money was to buy out a partner. Well, we restructured $8 million term loan plus a seller note plus an equity. That gets closed. That makes more sense. Your role is not to babysit companies figuring it out. You should expect clarity. Do not let them make you their business advisor. They should have a business advisor. Do not let them make you their investment banker. They're supposed to have an investment banker, unless they're paying you. Can you smell a broken model even before you open Excel? You see, this is where dreams go to lie. Start at the very bottom, actually. EBITDA margins, free cash flow, expenses. Did these things look realistic? Do they look realistic at all? Are they projecting 60% EBITDA growth while the headcount stays flat? That's not a business. That's a fantasy. If I want a fantasy, I'm going to go watch Lord of the Rings. Do the magic math check as well. Perfect linear growth, that's not a reality. That's magic. It's not going to happen. Negative working capital, that's not real. No CapEx on massive expansion, oh my God, that's a red flag. Revenue drivers versus fluff. Figure out the difference between the two and get that gut check, really familiar with that. If revenue shows 20%, plus with no breakdown, you need to stop. You need to ask for conversion. You need to ask for churn, prices, units, those type of things. Expenses matter. SG&A must increase with scale. Real companies have real costs. Healthcare, insurance, rent. If the CEO doesn't pay themselves, questions are needed. Why are they not paying themselves? And at what point are they going to suddenly decide to pay themselves without accounting for it when they ask you for money? Also, flash does not equal substance. A 20-tab color-coded model can be absolutely beautiful, but it can also be full of hot air. So let's put together a couple quick stress tests. Ask them, what if growth is down 20%? What's break even? Where's break even? When is break even? And how are you going to get there? And also what retail cash looks like, right? We had a model one time that left out rent, insurance, and debt service, plus it listed the CEO's boat as a marketing cost. The real red flag came when they got offended when they were asked to adjust it. Last thing you want to do, though, is deliver capital to a company like that, because at the end of the day, it's probably going to be your job, right? Is the founder a partner, or are they a landmine waiting to blow up your deal? I say this all the time. Deal quality is founder quality or sponsor quality. I will take an average deal or even a bad deal with a good client over a good deal with a bad client, because I know that a good client has a shot. What are my first impressions on the call? Is this person combative? Are they coachable? Are they insightful? Are they ego-driven? Coachability is so important. Are they refusing to fix a model math error? That deal's going to die. Clarity versus charisma. Good operators, they're very direct. Showmen, they tend to panic under pressure. I am not saying that you cannot be both, but if you have to pick one, pick the person who's very clear. Try the pushback test, right? Just say things like, that margin expansion seems a little aggressive. Just wait to see how they respond. Do they have a response to it? What they say is not as important as how they say it. And then process discipline. Are the materials timely? Is the data room organized? If they ghost you on the next steps, that's pretty telling. And also, extremely important, emotional volatility. If they complain about micromanagement after a few questions, that alone is a risk, right? We had a real deal breaker one time. We had a founder cut off angrily and aggressively a lender mid-question. You might be shocked to hear that deal died. Look, the bottom line is the deck, the people, they don't have to be polished. They have to be real, and more importantly, they have to be reliable. If they're willing to make changes when asked, that's a green flag. Look for things like that. Here's your cheat sheet to filtering fast and focusing smart. There's going to be 5 checkpoints, 1 minute on each one. 5 minutes, I think, is a very long time, but apparently in the banking world, it's not a lot of time at all. So, first one, clarity. Can you describe the business quickly? Number 2, ask fit. Does the structure and the size make sense? Number 3, model sanity. Are the assumptions real and are they groundable? And number 4, This is the one that I actually think is the most important. Founder behavior. Are they present? Are they coachable? Are they process ready? Number 5, process readiness. Is the data room live? Are the materials organized? Organized enough? Look, track which ones pass and close. Track which ones fizzle. Tune your radar accordingly. It's not cynicism, it's just discipline. The best lenders are editors. They're not yes people. They say no really fast, and they say yes very thoughtfully. I say this all the time. I will take a fast no over a long maybe. So to recap, you're looking for teaser clarity, you're looking for an aligned ask, you're looking for a grounded model, a solid founder, and process readiness. Those things in 5 minutes will save you so many hours and so much money I can't even describe to you. Thank you guys so much for listening or watching or both. In the next episode, we'll look at the capital raise process, maybe, or maybe I'll change my mind. Thank you guys so much for listening. Please, if you liked this, like it, subscribe it, share it, tell everyone, make user-generated content. Go to our website, midcapglobal.com, and spam our submission form. Please don't do that. But we're all over the place. You can always find us. You can always ask me questions. And hopefully you'll take these tools. You'll use them wisely. With great power comes great responsibility. And make no mistake, this is a superpower that I just gave you. So go close something.